Hello, Marc Ostwald from ADM Investor Services International. And this week I'd like to have a look at the much better than expected US labor data and also at the Fed's balance sheet and the Treasury's component of the Fed's balance sheet to make a couple of points. So my first chart today is to compare the US unemployment rate, which fell to 11.1%. And against the US underemployment rate. The underemployment rate, or the U6 rate, measures those people who would like to be working full-time but are currently underemployed. That stands at a much higher 18% and is probably a rather better indication of where we are in this particular cycle. As one can see, one's come from a level of around just below 7%, which matched the low of the last 30 years. Just before the pandemic made its enormous hit to the economy. So I think that's worth keeping in mind. The next thing is to say, well, is the labour market really improving that much? So my second chart today is of the weekly continued claims data. And this paints a rather less encouraging picture. What one can see is there was a very substantial drop in this measure from late April through early June, but in recent weeks, it's really not improved at all. And indeed, in the latest report that we had yesterday, it only went sideways at 19.29 million. So when we're thinking about the US labour market, we really need to bear that in mind. Thirdly, the third chart is about US permanent job losses, because some of the narrative that I'm hearing about the US unemployment data is the US created 4.5 million jobs in June. It didn't create anything of the kind. These were people merely going back to work to their previous, and this wasn't actual job creation. And if we're going to put it in those sort of terms, we really need to think about the fact that we've had an aggregate gain in payrolls over May and June of 7.5 million. Unfortunately, that compares very poorly with 22.06 million fall in payrolls in the March-April period. So we've recovered, or we've seen people going back to work, only about 1/3 of those jobs which were either furloughed or are more permanent. So this is why I've got this third chart here, which is of permanent job losses. And what that actually highlights is that June was the worst month that we've seen in the current cycle. And obviously, it's a very rapid cycle when one compares this to the global financial crisis, which is the levels on the left-hand side. But permanent job losses, 598,000, the most rapid that we've seen so far. So basically, labour market not quite so good as people are thinking. So what exactly are we getting from the Federal Reserve and the US Treasury? And I highlight these 2 points simply because there are concerns coming through from the latest report that we had from the Federal Reserve on its weekly report that we had yesterday. The first chart is of the Fed's balance sheet. As one can see, it declined again for a third week. The major contributor over the last couple of weeks has been actually central bank swap facilities, foreign central banks this is, which has been quite a major drag. That's actually a positive thing because it means there's less of a shortage of dollars in the world for other central banks needing to fill. On the other hand, it also says the Fed's not adding as much money as it was. And I think that's a very, very important point. In fact, when one looks at it, the Fed's basically increased its balance sheet from 4.16 trillion at the end of February to 7.01 trillion now. And as we come to my final chart, this is the US Treasury's cash balance of the Fed. There's 2 simple points here. The Treasury has actually built its balance sheet from cash balance of the Fed from 357 to 1.657 trillion at the moment. It had a little dip last week. That happens in the third week of every month. Why is it borrowing so much money and not spending it is my very simple question. And why is in the Federal Reserve's Main Street lending facility, has there been no demand so far? I think it's because there's a lot of uncertainty and people don't want to accumulate more debt, which means the Treasury should actually be spending a lot more of the money than it's actually been accumulating. Those are the thoughts for this week.